All right. Sorry about that. Let me go. You guys didn't see any of this, did you?
No.
See, if we were in a classroom, you could like throw a shoe at me, and then I would know. Well, if we were in a classroom, I guess you'd be seeing it. But anyway, okay. So this is a difference between U.S. standards and international standards. U.S. standards for inventory are the same for almost any allocation, and that is they must be systematic and rational. So how do you allocate the cost? It has to be systematic. There has to be a system to it. You know, two people do the same system and they come up with the same answer, same result. And rational just means it makes sense. And so this is kind of, this is one of those weird areas where the U.S. standards are actually, pretty loose. And there's probably like, I don't know, 30 or 40 different kinds of standards that you'll have for, different ways of doing inventory in the U.S. When I worked at Navistar, we had a whole bunch. We had like, we probably had 7 or 8 different types of inventory that we would do. Some of them were mixed between average costing and FIFO and all kinds of stuff. Okay. There is some allowance made in the international standards for flexibility, in that basically if you can make an argument for putting it and making it a certain way, a lot of times it's allowed. And by the way, they do that in the U.S. standards too for the publicly traded companies. They ask for a variance on the accounting rules, and some companies get them just because there's a lot of companies that the general standards don't really fit what they're doing. But anyway, just in general, the IFRS standards are less rule-based, but there are a few quirky things in the international standards for inventories. Okay, so design costs are not included in the U.S. They can be included if they're for specific customers for international standards. Interest generally is not included in U.S. Rules, and the only exception being for very large things that you sell, large things in inventory, like let's say you build ships, and it takes you 4 years to build a ship, right? You got a customer that's going to pay you $3.5 billion for this ship or whatever, and it takes 4 years to do it or whatever. Oftentimes they will, if there is interest involved in that, they will capitalize that and put that into it. But generally, for regular things, for regular inventory things, you don't capitalize interest, even if it takes a while to bring it to market. Okay, so let's go ahead and do problem number 1, and this is the international standards versus GAAP. And basically, a lot of times these kind of things you'll see as a multiple choice question, although they generally don't have international standards versus GAAP. They'll just say do it under the international standards or do it under the GAAP standards. They used to say what's the difference between them, but they generally don't do that anymore. Okay, so we purchased wood. Would that be okay under the cost of goods sold for international standards?
Yeah.
Yep. And we'd also have that for you. Now, wood storage costs. Now, sometimes wood has to be stored a certain way. So generally speaking, if it's necessary for production, and I'm going to make the leap if this is, you can put those storage costs, include those in. Conversion costs. This is a yes. I should probably talk about what conversion costs are. Conversion costs are, direct labor and overhead are conversion costs. So these are conversion costs are the cost of converting wood into whatever we're making here, chairs or Yeah, chairs. So we're making chairs. So converting the wood into chairs is a conversion cost, and it's direct labor and overhead is used to convert those. So for both of those, this would be included in the inventory. Design costs. These can be put into the international standards. They cannot be in the US standards. Finished chair storage. Generally, that's not going to be in either one of them. Let's see here. I used to include that with the. Yeah, no, here, storage. This is, these exclude storage unless it's necessary for the production process, and finished goods are not the production process. They're already finished. Okay, so this will be 0 for both of those. Normal waste, yep. Abnormal waste, no. Abnormal waste is simply a loss. And it'll go on the financial statements directly as a loss. Oops. And the totals. It's my stupid phone that didn't know to change my alarm. All right, let's see here. $106,000. And I imagine this one's 95,000. The only thing that's different is the 11,000. I better add them up. my confidence has been shattered. Let's see. Okay, yeah. So if they asked you what would the international standard cost be, it would be 106,000, whereas it would be 105,000 for, excuse me, 95,000 for the cost of gap. Question on that? Okay. Here is a big one. Inventories. They have a more limited choice in that they do not allow for LIFO. You cannot use LIFO for international standards. So, and I don't know if I talked to you guys about, I probably haven't, but LIFO, last in, first out. Now, last in, first out is obviously not the way most things are sold, right? I mean, you don't buy milk that's been sitting on the shelf for 3 years, because the last ones in are not, usually the first one's in and the first one's sold. When you sell out the milk, then you get some more milk in, and that's the way it goes. So first in, first out is really the natural flow of inventory. Last in, first out, virtually nothing sells that way. Okay, so the obvious question is, why do we even have it if it's not part of reality, right? economists will tell us that the last ones in have the most current prices and therefore gives you the most accurate income. So the closer to the the current price is closest to what the actual market price of it's going to be, and that's the most accurate economic income. So actually, LIFO is more of a theoretical for the income statement, not how do we account for the flow of inventory. International standards don't like that. They say, no, there's a flow of inventory, and we're talking about the inventory. We're not talking about hypothetical economists coming up with income. We're talking about what actually happened in the flow of inventory. The first one's in were the first one's sold and that sort of thing. So they don't let us use LIFO. So here's the weird thing. US are the only standards in the world that allow for LIFO. And generally speaking, it does what it's supposed to do, in that it gives us the most accurate income. In the United States, we're income crazy. We really get crazy about the income to the expense of the balance sheet. So, and for tax rules, some of the tax rules require that we use LIFO too. So in the United States, so here's a weird thing. Yeah, in the United States, if you have an international standards, for US standards, you can use LIFO. For taxes, in some cases, you must use LIFO. In international standards, you're prohibited from using LIFO. So it kind of creates kind of weird things and weird kind of tax issues too on the financial statements when you are a US company and you're using international standards, because the international standards do not recognize LIFO. It's a completely different system. And LIFO, when I say it harms the balance sheet. In LIFO, because you're only selling the last ones in, the first ones in might be sitting there for 30 years. You may have inventory that was on the books in 1961, back when people made $2,000 a year and were thrilled to do it. So you have these, you can have these kind of crazy inventory things happening if you are using LIFO on the balance sheet. The income statement is more accurate. Okay. Cost method and retail method, these are ways of estimating inventories. And they say these are acceptable only if they approximate the cost. And if you think about it, there's a kind of a funny anecdote for that, and that is that generally they use those two methods. The standard cost, well, standard cost is a standard costing system, it has a control to it, but the retail method is a way to do it much more quickly. But you also may have to do it the long way to show that it approximates the cost. So you got kind of a weird thing there that you may have to do you may have to test it with the actual, in which case, well, why do the estimated, just do the actual. Okay. Inventory is not interchangeable. Identical must be valued using a specific cost. Okay, that makes sense. For instance, like cars, some cars come loaded with a bunch of stuff, even though they're the same car. They're not identical. Okay. This is another one that is different than US standards. An entity must use the same cost formula for similar inventory items. US standards, as long as you put it in the in your notes of the financial statements, you may say that we sell electronic products with the using LIFO. We sell our mechanical products using FIFO and so forth. If they're in an inventory, of parts or whatever that you're selling, if they're similar, they must use the same formula. You cannot have two or more formulas for similar inventory. And again, that's different than the US. In the US, as long as you put it in the notes, let people know, that's fine. What I was doing when I was at Navistar, we used LIFO for our inventory for our production. We used average cost for the repair parts on that we would carry in inventory, and we'd also use a kind of an altered average cost for our repair and maintenance stuff that we didn't sell. Those inventory items were kept at a different it was kind of like a FIFO average cost mix thing. But anyway, and we said that in our financial statements. So, even though they were, we had three different kinds of inventory, they were, for instance, the parts and the production were very similar. An engine, you make an engine that might be a repair part, it might be sold singly, or it might be put into a truck. So, hey, that's not what I'm looking for. That's what I'm looking for. Oh wait, does that have my note there? Does that have that? Yeah, here's my email. So here's what I sent them. I sent them all the. Oh, they don't even have it. Here, look at all these classes I sent in. So these are all that I sent in, and your section is somewhere in there. Everyone has a section in there somewhere. And this is what I got back. By the way, hopefully this will be put in there soon. So anyway, okay. So what we're going to do is we're going to do LIFO, FIFO, just to kind of recall how we do this. And what we're going to do is do the LIFO and FIFO, and then as if we had it for US GAAP, and then calculate the differences between those. Okay. Yeah. Okay, so for problem number 2, what would the sales be for January? Actually, a question I don't know the answer to yet. Hold on. So how much would the sales be?
2,400.
Yep. So I'm gonna put up here, we have units. Oops, not that. Excuse me. And we have the price. So we sold 160 units. And the price was 15 each. So 2,400 came in. And sales are, for the most part, pretty easy. At least if we're selling units, pretty easy. So sometimes revenue recognition can be a little tricky. Okay, first in, first out. So first in, first out really means the first in, first sold. So the first one's in where the first one's sold, which is kind of what you would normally think would probably happen with inventory. And if you think about it, if you sold a toy car on January 3rd, it would have had to come in from this first in inventory, right? This stuff that was first here. Oops. Okay, so cost of goods sold. Sometimes this is called COGS, by the way. You'll hear it called COGS. When I was at Navistar, one of the first jobs I was at, the guy kept talking about COGS. And we were at an engine plant. And so he kept talking about COGS. I'm like, man, they must use a lot of COGS here. And then I realized he's talking about cost of goods sold. That's really stupid. But anyway, all right. So I've got to find the cost of goods sold. So we need the cost for. Oops. 160 units. So first in, first out, we're going to go where first? Beginning inventory. So we don't have all 160. We have 100 of them, and the price is they have the same cost each of those. What am I doing here? Read this stupid thing. Okay, we're gonna do something different here. I'll let you guys choose a number, but let's do something different here. I can't believe this. What idiot would do that? Okay. And so these will be at $10 each. And this cost, so this would be, that layer would be what, 1,000? Okay, we're gonna come up with a new number though for the purchase on the 16th. Let's pick a different number. It can't be $10. Let's make a different number.
$12.
$12. Perfect. Okay, so let's make this $12. So everybody change this to 12 if you would. Okay, so if they're all if they're all the same price, it doesn't matter what method you use. Using average cost, LIFO, FIFO, it all come out the same. All right. So we found the first 100 units. How many more do we still need to find the cost for?
$30
More.
or $60.
60, yep. Okay, so we need to find the cost of 60. Now notice at this beginning inventory, this is gone. Wait a minute, this one. Okay, so that beginning inventory is gone. So now we're down to the next first in. So we need 60. Now, again, there's 130 in that layer, but we don't need 130. We only need 60 of them. Right? We only need to find the cost of the other 60. So we need to find a total cost of 160 items. We already got 100. And now here's the other 60. And our new cost on those is $12. 60 times 12. 72, 720?
Yeah.
Okay. And this is going to look really stupid. I'm going to put it in anyways. You know, and after you don't need to find the cost. You only need to find 160 of them, and that's what we got. You know, we need the cost for this, the 100. Oh, don't do that. We really just need the cost for 160 items, and we actually got 100 from the first layer and 60 from the second. So we don't really need any more costs here. Oops. All right, so the total was 1,720. So this is our cost of goods sold. This is our sales. So calculate the gross profit or gross margin. Same thing. We have our sales, 2,400. We have our cost of goods sold. Subtract out. So, you know, cost of goods sold, it's similar to like an expense in some ways because it's their assets leaving the place. You know, so for instance, if I sold it, to put it into our problem, if I sold this for $2,400, but it cost $1,720 to make it, right? Once I made that sale for 2,400, okay, I got 2,400, but they're taking this. This is leaving. We don't have that asset anymore. So it's not cash leaving the place, but cost of goods sold is actually inventories that are actually assets, other assets, not that aren't cash, leaving the place. So it's inventory that's leaving the place. So that's why we subtracted out that we can't sell this again. It's already gone. So cost of goods sold is actually the inventory leaving the place. And this will give us our gross margin or gross profit. Uh, 380, 780, maybe. $680. I should know you guys are being quiet. Oh man, he goofed it up again. Okay, our ending inventory. Now notice up here, that of that 130 that we sold, oops, 60 of those. So how many are left? 70? So sold, oops, no, don't do that. So sold 60. Cross that out. So this is what's left in our ending inventory. Now let's make that, there we go. So this is what was not sold. So this will be our ending inventory. So ending inventory, this is what was not sold. And put in our new $12 cost. 840. I think. So this will be our ending inventory. So our ending inventory, this is what was not sold. And this will be our beginning inventory next time. Now it's 5 o'clock, and I think I told you guys I'd be done by 5. I'm going to push through this one just to have it in the in the video, and then we'll call it a day for this. Okay, so this will be the same thing, except that they are going to use the LIFO method, last in, first out. And again, nothing actually flows this way, but this is a theoretical that you get a better. Let me change this down here to 12. Yeah, make the same change we did before. Change that to 12 if you would. And so here's what economists will tell us, that this $12 is more accurately will reflect our income than earlier numbers. The closer it is to the end of the month, the more relevant the numbers are. And that's why we use them, because they are theoretically more relevant for the income. Nothing flows that way. Firstly, nothing flows that way, but we use that method as it's a theoretical method for more exact income. Okay. Here, I'm going to show you guys how to be lazy like me. Sales are sales. It can be exactly the same. I'm going to copy that. Ah! Sales are sales. Okay, now comes the cost of goods sold. Our same 160. Oops. Units. Cost. And we need the cost for 160 units, same as before. Now we're going to use the last ones in, which are which ones?
$130.
Yep. So we're going to take the last ones in. These are the last ones in. And again, we know that these are not really, those aren't really the first ones that we sold. But theoretically, it's a more accurate number. $15,600. 13 times 12. Yeah. Oops. Okay, so these are gone. They're not coming back. And we still need a cost for how many?
30.
30. So we need a cost for 30 more. And so we're going to go up to this beginning inventory. We're not going to take all 100. We don't need all 100. We need 30 of those. $10. $300. And again, after this, we don't need, you don't need to put this in. I don't know why I do it, but we got all the costs we need. We sold 160 units. We found the cost of 160 units. And so that came out to 1860. So coming out here, our sales, same 2,400. Our cost of goods sold, 1860. And this will give us our gross profit. Or gross margin, same thing. 540. Check that just to be sure. Yeah, 540. So this is our gross profit. Our ending inventory, we sold 30 of those. So our ending inventory will be 70 units at $10 each. So this will be our ending amount. So our ending inventory will be the beginning that we had at 70. And by the way, you'll notice that these are from the very beginning. As years go by, if we don't sell all the inventory down, this inventory could sit on the books for theoretically 100 years. They could be on there. Okay, so ending inventory. Ah, okay, what would be the difference in income and inventory between problems 2 and 3? Well, our gross profit for 2 was 680. Minus gap, stay US. Is that 140? And our IFRS ending inventory was 840. So that means inventory was 700. And so we will be off by the same 140. Oops. So income. So the difference is that well, we have to say which is which. So the income would be. Do I know what you want to say? It would be higher. Oops. By 140 under international standards. And any inventory will be higher by 140. And if you think about it, they really have because they're using the lower cost for the first ones that were sold. That also means that they have those higher costs are still in the inventory, so they still have those higher dollar number value in the inventory. So their ending inventory will actually be more accurate. These have the more current dollar amounts in it. So it's basically the difference between LIFO and FIFO is the difference between the income statement and the balance sheet. LIFO theoretically gives a more accurate income statement. FIFO gives a more accurate balance sheet. And FIFO is more accurately the way things flow. So that's what. Okay, let's stop here. I know you guys got a 6 o'clock coming up. And I sincerely apologize. It will never happen again. Yeah, we'll get to this next time. Okay. I think I'll send out a chapter 1, 2, and 3 exam. It's just going to be the financial statements and a couple questions on what if the exchange rate was X dollars? What would the cash be? What would the liabilities be? Just to kind of get familiar with the financial statements again, but also just to also that there is a conversion thing here that we'll do more of that later on. And the conversion is taking those things that are even though we're doing the different accounting standards now, there'll also be different numbers that come through because the translation into US dollars. So there's actually two things going on here. And the one that we're learning for chapter 4 is the accounting standards. This generally has nothing to do with the actual what the actual underlying currency is. You could keep your books in US dollars and use the international standards. It's perfectly allowed. But you could also be in a foreign currency other than US dollars. So first we're going to go over the difference in the standards, and then we're going to go over the translating those standards, translating those into US dollars. Okay, so let's stop there. So I'm going to send out a test. I'll send out a test. Again, it'll be very similar to what's in the handout for chapters 1, 2, and 3. And we'll come back and pick this one up. And I think we might do a couple problems out of the book for this one next class. And I promise I'm going to be early next class. So anyway, I will see you guys next week. And I'm still hopeful that we get these, the book will be up and running. If it doesn't, I'm just going to take the stuff out of the books and put it right, inside you guys' handouts with it. The book problem. So don't worry about, gee, we don't have access to the book. We can't do the problems in the book or whatever. If we can't get this settled by the next time around, I'm just gonna send them out. Any questions?
Okay. No, I'm good.
Okay, and I will see you next week. And next week we'll start at start at 4 and end at 5. Okay. Good night.
Good night.
Good night.